So you buy a call on Google that expires in 2 days at $165. You pay a $3 a share premium. So if Google in 3 days expires anything greater than $168, you profit. You understand this. We've already covered these ideas in this video series, but today I'm going to talk about some more complex options trading strategies, some spreads, selling options to generate income into your portfolio, and so on and so forth. Hopefully you're looking forward to it. Hit the like button if you are, and let's go. Let's start with the banger. Let's start with my favorite option strategy, the wheel strategy. It's a strategy that allows you to sell option premium to assume risk for profits. Remember, but on stocks that you want to own anyway. So in reality, there is no extra risk to you. It's all upside potential capital gains. Now, can you still lose money? Of course, you can still lose money. But as we discuss this strategy, you'll understand what I'm talking about. I performed this strategy a handful of times on the Google chart during the 2022 bear market. At the time, Google was my favorite stock in the stock market. I thought it had the best numerical fundamental valuation out of any stock I could find in the stock market. So I was happy to own shares of Google. I was looking to own shares of Google. That's when you can imply this wheel trading strategy. So markets are dumping. The entire markets are dumping. Google is dumping. It is breaking down below 100, below 90. It even touched just about 80 down here during the bear market. Well, I decided when Google was trading, I believe it was trading, I don't remember the exact trades, but it was trading around 100. I decided, hey, if Google gets to 90, I would like to buy 100 shares of Google. Instead of just waiting for that to happen, if that's your plan, if that's what you're going to do, buy a multiple of 100 of a stock at a specific price, there is zero reason why you shouldn't be selling a put, right? Let me explain this. We haven't talked too much about what happens when you sell options in this video series yet. I went and I sold a Google option at the $90 strike. I sold it for a $250 premium or whatever it was. Guess what? I get to keep that premium. As long as I let that option expire, no matter what happens, I get to keep that $250. If Google expires greater than $90, so it doesn't get down to the price that I want to buy it at, nothing happens. I collect $250. Great. It didn't get to 90, whatever. I just get to now collect a free $250 while I wait for the stock I want to buy to get to the price I want to buy it at. Now, if Google does tank, say it goes and it expires at $80, guess what? First off, I still get to collect the $250 of premium. I sold that risk. That money is still mine. But now I have to buy 100 shares per contract that expires at $90 while the stock is trading at $80. That's a 10-point loss. So for every 100 shares, you'd lose $1,000. But the point is, and why you do this only on stocks that you want to own, you were going to lose that $1,000 anyway, right? Now, since you sold the put and you collected $250 of premium, you actually are only down $750. So you own the stock where you wanted to own it anyway. And yes, you lost money, but you actually protected your downside risk from what you would be down normally, right? So there's no reason, once again, just to reiterate, if you are waiting for a stock to get to a specific price to buy, and you're going to buy at least 100 shares, right? Every option contract is leveraged to at least 100 shares. So if you only want to buy 10 shares of something, this won't exactly work. But if you want to buy 100 plus shares, there's no reason in that instance you shouldn't be selling a put. Now, let's talk a little bit more technical about the aspects of where you should be selling puts according to expiration, according to strike price. Now, the exact option that you decide to sell is going to be up to your own risk management metrics, right? We talked on the part 2 of this video series about intrinsic and extrinsic value and how the riskiest stocks, the stocks with the most extrinsic value, are the ones nearest to the money and nearest expiration. So if you want, higher risk, of course, if you sell this put that expires in 3 days, you can collect premium faster, but you're going to be, in much more dangerous territory if a move happens that this put is going to gain a ton of value that you are short in your selling of the risk premium, right? So what I do, and once again, this is just my strategy. You're going to have to decide your own. What I did when I was trading the wheel strategy, I went a month out. Today is May 1st, so I would go to whatever's the closest. I'd go to this June 7th. That's the one I would select. And then I would choose whichever delta was closest to 30 cents. So, or for a put, minus 30 cents, of course. But I would go a month out, 30 delta. So if I wanted to sell a put on Google right now, and I'm not saying I do, well, I don't because I'm not going to do it. But if I wanted to sell a put on Google right now, I would sell this June 7th 160 strike put. I'm sorry, you probably can't see the delta. Let me move my big fat head. You can see the delta here now. Sorry, if you're watching this video in 1080p and can see the small number, the delta is sitting at negative 0.28. That's the put I would look to sell. But there's one more thing that I check, and it's why I don't want to perform the strategy right now necessarily. This is marketchameleon.com. I have no affiliation with this website, but I do use it to decide the best time to sell options. You do have to create an account on this site, but it's perfectly free. At least I'm doing what I'm about to show you with just a free account. So I'm going to look up the ticker GOOG, and then I'm going to come into volatility, implied volatility, and this bar here is showing you the implied volatility graph, the average of the last 30 days. What I do is I turn on also the historical volatility moving average of the last 252 days. So this is the moving average of the last year on IV. Once again, we talked about this in our option pricing video, but options are more expensive the higher the volatility is on the underlying ticker, right? That IV gets baked into the price of an option contract. You want to be selling options when they are more expensive. When they have more value for you as a premium seller to collect, that's when you want to be selling them. So I will only sell options if the current 30 IV is above the historical moving average from the last year. And actually, over the last, couple of weeks or whatever, it actually has been well above, which is interesting. But also, and I should mention this, I also just won't really perform the strategy on Google right now because it's at all-time highs. I really have no interest in, I don't see a lot of value going out and buying Google right now. So that's, also my fundamental analysis bit of it, but that's the important technical takeaway. Once again, marketchameleon.com. Once again, no affiliation. Go make a free account over there. Make sure when you're selling options, you are selling expensive options. All right, so we just discussed in detail selling options, and that in and of itself is an option strategy, right? But we are talking about the wheel strategy here, and there's a very important part 2 of the wheel strategy that we need to get into. So if I jump back in and let's say once again, what did we sell? We sold this June 7th 160 strike put for $250 on Google. I have $250 in my account. Yay, yippee. Now let's say on June 7th, Google closes at 155. Okay, I now own 100 shares of Google at 160, even though it's trading at 155. That puts my shares down $500, right? But since I collected the $250 in premium, I'm actually only down $250, and I own a stock that I wanted to own at a price I wanted to own it anyway. So we're sitting down $250, and we have 100 shares of Google at 160. The next step of the option wheel strategy is to once again go a month out. So in our scenario here, today is June 7th. I would jump to this July. By then, there would be new weeklies, so it wouldn't probably be this July 19th. There would probably be a weekly, more like July 7th. But since we're jumping too far ahead in the future, let's go to this July 19th. Let me move my head out of the way. What do I own my shares at? I own my shares at 160. I will now sell a call against my shares. This is called selling a covered call, and it works very similarly to the selling a put conversation that we just had. If I go to the, I would go to the 30 delta, which right now is sitting at 180. So if I sold this 180 strike call for $350 is what it's currently trading at, I collect the $350 in premium. So now in my total position, I'm now up $100. Nice. Now, if on July 19th, once again, Google closes below 180, I keep my shares, I collect the $350, I would go another month out, I would do the same thing. Now, if on July 19th, it expires above 180, it expires, Google's trading at 185, I have to sell my shares at 180. But once again, guess what? I still got to collect $350 in premium, and I get to sell my shares for 20 points of profit. So I end up making in total, what is that? Something like $2,250 in that trade. And like the likely scenario, what normally ends up happening with this wheel strategy is you go a month out, you sell a put, you don't get filled, you collect $200 or whatever in premium. You go a month out, you don't get filled, you collect $200 or whatever in premium. You do that a handful of times, maybe eventually you do get filled. Once again, now you own the stock at a price you're happy to own it. Then you go sell a call, you most likely don't get filled, you collect the premium. You sell a call, you most likely don't get filled, you collect the premium. You sell a call, you do get filled, you still get to lock in a nice profit on your shares, even though you didn't get to maximize the share value and lock in the premium. You're seeing the power of the wheel strategy in how it can generate revenue for your investment portfolio on stocks that you want to own anyway, at areas you want to buy them and areas you want to sell them anyway. Just while you wait for those two areas to hit, you get to collect premium by assuming the risk of the option buyers. The second strategy we're going to talk about in this video is a straddle. This strategy, the price of the contract is much more directly affected by the movement in the underlying than the wheel strategy is. Today is actually a perfect day to talk about this strategy. Today, as I'm making this video, is a Fed interest rate decision day. So there is a lot of IV baked into the movement of the S&P. There's a lot of expected volatility from whatever the Fed decides and then the Fed chair speech afterwards. Say I think there is going to be a large move today, but I'm not sure their direction. How many times have you heard you can't predict what a stock is going to do over a short period of time? With this strategy, you don't necessarily have to. You don't actually at all have to decide the direction. If you think there's going to be a large move, what you can do, and what I'm going to do here is utilize this Analyze tab inside of Thinkorswim. I'm going to go analyze a buy of an at the money, so the most recent strike price above what the stock is currently trading at, a straddle. If I then jump into, did I not analyze? I think I went to buy. Let me go to analyze a straddle. Yeah, I don't actually want to place this trade. Then if I jump into my risk profile here, I bought a 501 call and I bought a 501 put. This makes 501 my inflection point where I would lose the most amount of money. I would lose all the money that I've put into these contracts if SPY were to stay at 501. These red lines signify where you go from losing money to making money. So today or tomorrow, SPY is above 504.85 or below 497.25. I'm profitable. And then, of course, the further away it is, either up or down, the more money I make. You see how this works? I bought a put, yes, and I bought a call at the same price so that no matter which direction the stock moves, I will make money. I'm just betting on heavy volatility here, on a huge move either direction. Let me show you one more thing. You can do the opposite of this trade. Once again, this 501 May 1st expiration. If I analyze a sell trade of a straddle, and then once again, let's just change this to 1 instead of 10 contracts. What do you think this risk profile is going to look like? 501 is now my inflection point for where I make the most money. And if it drops below 497 and a quarter or above 504 and a half, I start to lose money. So if you don't think that there's going to be a very volatile move, you can sell a straddle. Right? Does this make sense? Buy a straddle, take advantage of any directional volatility. If you think the market is pricing in too much directional volatility, if the IV, if the implied volatility and other extrinsic values are too high on options, the market is pricing in too much of a move, you can sell a straddle to take advantage of that as well. Let me mention this as well before moving on. In sort of every profit or loss scenario on options so far, I've really only focused on what happens at expiration because that's the easiest to understand as a beginner, the intrinsic value of the contract that you own. But when you're in spreads like this, or if you're in any contract, any single contract, any contract you're in, of course, while you're in the trade, the price of the contract, the intrinsic and extrinsic values of the contract will also be changing, and you can exit your contracts before expiration as well, right? As long as there's a willing buyer or seller, depending on what side of the trade you're on the other side, you can exit your contract whenever you want to. So if you're up, a couple $100 in a trade, you don't have to wait until expiration. Once again, as long as there's, someone you can exit your trade with, you can get out of your contract before expiration at the price it's currently trading at. Last but not least, the third strategy we're going to cover in today's video is a call credit spread. This one's extremely important because if you want to sell a call on a stock, you think a stock has gone too high, it's not going to go any higher, you want to collect a little free premium on top of it, that has a potential unlimited loss. If the stock keeps going up, you will continue to lose more and more value because the intrinsic value of a stock going up is technically infinity, right? But what a call credit spread is going to do for you is it's going to limit your downside risk when looking to collect premium on calls. I'm a trader that thinks SPY has gone way too far to the moon here. I think I can collect some pretty easy premium by selling a call. I don't think it's going to fly any higher than it's already gone. Well, if we jump into our risk profile here, you can see I have turned on selling a single SPY contract that expires today, actually, at $500. If I jump back in, that is selling a call that is the nearest to the money. That's the premium I want to collect, and the current value of it is $210. So if we look this way, if you look in the bottom left there, you can see your max profit is $210. If SPY expires at all below 500, I'll collect my $210 premium. Of course, if SPY goes to 520, I'll lose almost $1,800, right? There's a lot of risk in selling a straight call. So to build a call credit spread, this is what I'm going to do. Remember, I am selling the 500 strike call. What I will do is I will go out to a higher strike price and I will buy one of these calls. So if I analyze buy of one single 505 call at $47, if I jump back into my risk profile, you will now see that even if SPY gets to 520, my max loss is now only $335. I cannot lose more than $335 in this trade. My loss is capped. Now, keep in mind, what was my win before? Like $211, right? I'm now only winning $167 because, of course, I would lose the premium that I paid for that long call. The $47 I paid for that long call, I would lose, right? So, yes, it limits your gain a little bit, but if you're going to, if you're looking to sell calls, you're probably going to want this kind of protection because you can sell calls 100 times and then just one time be wrong and the stock flies and you can give up all of those gains if you aren't properly protected. So that's the call credit spread simply explained. That's all the option strategies for this video. Hey, if you're interested in more objectified trading strategies, why not check out my website, daytradingstrategies.net, where you can access over 40 different codes, from strategies to scanners to custom indicators, mostly for thinkorswim. But even if you don't use thinkorswim, there's a handful that can be copied and pasted into TradingView as well, which of course anyone can download and access for free. So daytradingstrategies.net. Click the link at the top of the description down below. Go sign up. Become a better trader today. But once again, that's going to do it for this video. Make sure you like, make sure you subscribe, and check out the video that YouTube recommends for you on the outro screen.
Trading stocks. He talks about trading stocks. It's important for you Americans and other international individuals to learn about stocks.